Welcome to the Deep Dive. This is where we take source material, break it down, and give you the knowledge you need. Today, we're looking at two things with similar acronyms, VWAP and VWA, but they're really worlds apart in crypto. On one hand, you've got VWAP, volume weighted average price, and its cousin TWAP. These are like the serious tools for institutional trading, very precise. And on the other hand, VWA, a token that popped up recently, and its value seems, well, let's just say it looks driven by hype and some pretty confusing branding. So our mission today is pretty straightforward, to give you the basics to understand both, how pros measure real market value and the serious risks when value seems totally made up. We want you to spot the signal from the noise.
Yeah, it's a great contrast. We're talking about something foundational like VWAP. I mean, it's been used in TradFi since, 1988?
Right.
And then you compare that to something like VWA, which feels very current, very hype-driven. It's really about objective value versus, speculative fever.
Okay, let's get into it. VWAP first. Volume-weighted average price. The sources say it's a Wall Street staple, especially for big funds moving big money. But for someone trading day-to-day, what's the core idea? Why is VWAP considered such a solid benchmark?
Well, VWAP is really all about judging how well you executed a trade. Think about it. If you're an institution trying to buy or sell a huge amount, like millions in Bitcoin, just placing that order can shove the price around. That's market impact. It works against you.
Okay.
So VWAP becomes their target. Their goal is to get their whole order filled at an average price that's super close to that day's volume-weighted average price. If they pull that off, they know they didn't mess up the market too much and got a decent average cost for their size.
Right, so the weighted part is key here. It's not just averaging prices across the day randomly.
Exactly. You don't need the fancy math formula right now. The main thing for you to grasp is VWAP tells you if you're paying more or less than the average dollar actually traded today. So if like 90% of the day's trading happened around 50K, VWAP's going to sit near 50K. Even if the price briefly shot up to 52K, that spike doesn't count for much if there wasn't much volume there. It respects where the real money flowed. That's why institutions trust it as a baseline.
Makes sense for markets with lots of activity. So how does TWAP, time-weighted average price, fit in? How's it different? When would you pick time over volume?
TWAP is much simpler. It doesn't really care about where the volume is. It just takes a big order, chops it into equal little pieces, and executes those pieces at regular intervals over a set time, say every 5 minutes for 4 hours. It totally ignores the volume spikes and dips. So TWAP is your friend when you need to be sneaky. Like in a market with low liquidity or an asset where a big order would cause massive slippage, TWAP helps you fly into the radar.
Right, keeping it quiet. Is there a good example of this in action?
Yeah, the sources point to MicroStrategy's early big Bitcoin buys. The $250 million purchase back in 2020. They didn't just drop it on the market at once. Nope. They used a TWAP approach, spread it out over days. They just blended in with the normal daily trading, got a good average price, didn't cause a huge price jump. Didn't alert the whole market they were buying big.
Okay, got it. So pulling this together for daily trading, if I want to fit in with the market flow, especially during busy times, and avoid pushing the price, I think about VWAP. But if I'm dealing with something less liquid or I just need to be discreet, maybe TWAP is the better tool. That's a really useful tactical difference.
Exactly. Choosing the right tool depends on the situation. Now, moving past just filling big orders, VWAP is actually a really handy tool for active traders, strategy-wise. Think of it as the day's equilibrium point, price-wise. If the price is currently above VWAP, it suggests buyers are in control, paying more than the average price paid today, considering volume.
Okay, but VWAP seems tied to a trading day. Stocks have opened and closed. Crypto doesn't.
Right.
That must make it tricky, right?
Oh, absolutely. It's a key difference. Since crypto runs 24/7, there's no official end-of-day bell. So traders kind of have to create their own structure. Usually they'll reset the VWAP calculation at midnight UTC or maybe use a rolling 24-hour window. But, and this is important, you have to be aware that crypto volume isn't evenly spread. It might surge during US hours, making VWAP more defined then, and then go flat overnight. You need context.
So let's get practical. How do traders actually use this daily equilibrium line to make decisions? About entries, exits, risk.
The sources highlight three main ways. First up is mean reversion.
Okay.
The idea here is that price tends to snap back towards its average, like a rubber band. So if an asset's trending up, a trader might look for a pullback towards the VWAP line to buy. They're using VWAP as kind of dynamic support level.
So buying the dip back to the average, what about going with the trend instead of fading it?
That's the second strategy, trend confirmation. This is simpler. You just use VWAP as a filter for direction. Like a trader might say, I'll only look for long trades if the price stays consistently above VWAP, confirms the bullish momentum for the day.
And shorts only below VWAP.
Exactly. It keeps you aligned with where the volume is flowing today. And the third one is about risk management. VWAP helps spot when things get stretched. If the price suddenly rockets, say 5% above VWAP, that's a signal. It means the price is way extended from the average cost basis of today's volume.
Like it's gotten ahead of itself.
Precisely. A smart trader might pause on new longs there, maybe tighten stop losses on existing ones, or even look for signs of a reversal back towards the VWAP. The price is stretched, likely can't sustain it.
Okay, charts can get messy with too many lines. I know a lot of listeners use EMAs, exponential moving averages. How do VWAP and EMAs compare? Should you use both? Doesn't that just lead to, analysis paralysis?
That's a really good question. It's only paralysis if you don't know why you're using each tool. They're definitely not the same thing. See, VWAP cares about volume, and it resets every day. It's purely an intraday indicator for dynamic support or resistance based on that day's action.
Right, daily reset.
EMAs, though, they're calculated continuously. They give more weight to recent prices, sure, but they completely ignore volume. So they're better for seeing the longer-term trend, like across days or weeks.
So the difference is really about the time frame they're useful for.
Pretty much. You can use them together. Use VWAP for your immediate intraday bias. Is the price strong or weak compared to today's volume? Then use a longer EMA, maybe a 50-day or something, to check the bigger picture trend.
Okay, so like a filter.
Yeah. If price is above daily VWAP, short-term bullish, but still below the 50-day EMA longer-term bearish, that conflict tells you to be careful. Maybe trade smaller or wait for alignment. Oh, and briefly, there's also something called anchored VWAP. Standard VWAP works best on short charts, like 1 minute, 5 minute, 15 minute. But anchored VWAP lets you start the calculation from a specific major high or low point in the past, so you can get a volume-weighted perspective stretching over weeks or even months, anchored to a key event. It's quite powerful.
That's interesting, but it brings up a huge point, though. All this VWAP stuff, measuring average cost, execution, it assumes the volume is, real, organic. What happens when the volume itself might be fake or controlled or just driven by rumors? That feels like the perfect pivot point for our discussion.
It absolutely is. Because when you can't trust the volume data, these sophisticated tools like VWAP start to lose their meaning. And that's exactly where objective analysis kind of breaks down and you step into a zone of much higher risk.
Okay, so we've seen how pros use VWAP to measure real volume-backed value. Now let's do that pivot. Let's dive into the VWA token, where the value seems to come from. Well, something else entirely. Viral hype, mostly.
Yeah, VWA. Launched on Solana, October 2025. And a fascinating case study in modern crypto hype. It was initially marketed as a real-world asset project, RWA, claiming it would tokenize things like gold, silver, gems.
Okay, RWA is a hot narrative.
Right. But right away, things were fuzzy. The project called itself RWA, but its on messages sometimes talked about being Wall Street's Vanguard warrior. And then third-party sites just started calling it a meme coin. So mixed signals from the start.
And the name itself, VWA, Vanguard RWA, that seems intentionally confusing.
Oh, absolutely intentional. Using Vanguard RWA and the VWA ticker, that immediately creates a link in people's minds to Vanguard, the massive, $9 trillion asset manager.
But there's no actual link, right?
Yeah, none whatsoever, according to the sources. No connection to Vanguard or BlackRock or any major institution. But that branding creates this illusion of legitimacy for retail investors who maybe don't dig deeper. It's pure misdirection using a name.
Wow, and then the hype just went nuts, didn't it? I read about that bizarre rumor.
Oh yeah, this is where you see the psychology kick in. There was this rumor, completely debunked later, that VWA was going to be featured in an episode of The Simpsons.
Wait, The Simpsons? Seriously? And people bought into that, a cartoon rumor.
Apparently, and look what happened. That completely baseless rumor fueled this huge speculative pump. The market cap reportedly shot up from maybe $100K to over $7.5 million almost instantly. Daily volume hit over $1.3 million.
Just based on that.
It seems so. It's all about FOMO, fear of missing out, fueled by how fast rumors spread on social media now. Doesn't even matter if the rumor is true. Just the fact that there's buzz is enough for some people to jump in. And that wasn't the only claim. There were also unverified whispers about being backed by Ripple or getting integrated with Swift. Again, no proof. Just marketing stunts to generate quick pumps based on hope, not on any real substance or audited work.
Okay, this is crucial. If VWAP helps measure execution in honest markets, What's the metric we should use to gauge the risk in something like VWA, where everything seems suspect?
You look straight at token ownership concentration. That's your number one objective red flag for these kinds of speculative plays. And for VWA, the on-chain data, it paints a really worrying picture. The sources we looked at showed that a massive chunk, somewhere between 87% and 90% of all VWA tokens,
87 to 90%,
is controlled by just 50 or 60 wallets that seem to be connected.
That's not just centralized, that's almost total control by a tiny group.
Exactly. It means a handful of insiders hold nearly the entire supply. This gives them immense power to manipulate the price. They can coordinate buying to drive the price up, creating that illusion of volume and demand we talked about. And then they can dump it all at once.
That classic pump and dump.
Precisely, leaving regular buyers holding bags that become worthless very quickly. The risk profile is extreme because of that concentration.
And if you look for the basics you'd expect from a real RWA project, transparency about the assets, audits, who the team is, what do you find with VWA?
Basically nothing verifiable. You compare it to established RWA projects, and VWA just doesn't measure up on any standard benchmark. The developers, anonymous, huge red flag right there.
Sure.
No accountability. There's no white paper. No detailed documents explaining how these supposed physical assets are audited, where they're stored, how their value connects to the token on-chain. None of that crucial RWA infrastructure seems to be there. Those claims about tokenizing real assets, still totally unproven. And the smart contracts themselves haven't been independently verified or audited either. So for anyone even thinking about touching this, VWA is incredibly high risk. It's a gamble. The liquidity outside that small group of insiders is likely very thin. It's tailor-made for price manipulation. Extreme caution isn't just recommended, it's essential. #HajOutro.
So this deep dive really highlighted the massive gap between professional measured execution and just pure wild speculation. We looked at VWAP, how it measures value weighted by actual volume, helping big players trade fairly and defining what an honest market price looks like for the day. And then we contrasted that sharply with VWA, where value seems entirely manufactured through hype, misleading names, and dangerous levels of insider control.
Yeah, the key takeaway is this. Technical tools like VWAP give you context based on volume. They tell you where the money actually flowed. That's crucial for execution strategy. But you have to layer on market context. Things like token ownership concentration, verifiable partnerships, team transparency. That gives you context for risk. One tells you about the trading activity. The other forces you to question the legitimacy of that activity itself. VWAP adds a layer to strategy. VWA demands extreme skepticism about the whole setup.
So here's the final thought for you. In today's markets, you've got complex algorithms trying to precisely measure real volume, and you've got viral rumors trying to completely fabricate it. Understanding the fundamental source of price movement, whether it's genuine, weighted volume, or just unverified, centrally controlled hype, that might be the most important indicator of all for managing your risk. That's your deep dive for today.